At the start of last year, there wasn't much optimism about the global economy. China was still struggling with the aftermath of its property crisis, lots of big European countries, including France and Germany, looked sort of stuck, and there was a widespread anxiety that Trump's tariffs would be the nail in the coffin. But despite various geopolitical crises, the occasional war, and the fact that Trump has actually introduced some pretty unprecedented tariffs, the global economy has actually done, well, all right. Stock markets across the world have continued to boom. Inflation has come down in most developed countries, and the IMF reckons that the global economy actually grew by 3.3% in 2025, roughly on par with 2024, and way better than the more pessimistic forecasts that we saw throughout 2025. However, over the past couple of weeks, the global economy has suddenly started to feel a bit shaky, and investors have started piling into traditional safe haven assets like gold. So in this video, we're going to explain why things suddenly feel a bit wobbly, and how worried we should really be. We're in the process of clearing out our store, so we're running a fire sale right now. Using code FIRESALE, you can get 40% off all of our posters, notebooks, calendars, magnets, keyrings, Brexit the colouring book, the lot. That offer ends very soon, so click the link in the description for more. So we should probably start by saying that this isn't investment advice, and you probably more generally shouldn't be taking investment advice from YouTubers anyway. With that out of the way, let's get into it. There are lots of reasons to think the global economy might be looking a bit shaky at the moment, but perhaps the biggest red flag is the ongoing surge in the price of gold, which has now risen to an all-time high of nearly $4,900 per troy ounce. To put that price in context, between roughly 2013 and the pandemic, gold traded at between $1,000 and $1,500 per troy ounce, which means that the price has essentially tripled relative to its pre-pandemic average. The price of gold has been rising pretty steadily since really the start of 2024, but things have got parabolic in recent weeks. Something similar is apparently happening with silver, which has seen its price nearly quadruple to $95 per troy ounce in the past few weeks, having hovered at around the $20 mark for most of the past decade or so. Now at this point, you might be asking, why is the rising price of precious metals a red flag for the global economy? And well, the short answer is that gold, and to a lesser extent silver, is widely considered the ultimate safe haven asset for investors anticipating some sort of crash. This is for a number of reasons. First, it's been a universally accepted store for value throughout history. Second, there's no risk of default like with government or company issued debt. And third, its value can't be easily eroded by inflation, unlike cash, at least in a fiat currency era where cash is issued by central banks and not pegged to any commodity, as it was in the gold standard era. So this is why its value goes up when investors are nervous or anticipating some sort of crash that would undermine the value of normal money. And well, the fact that both gold and silver are skyrocketing to all-time highs is pretty clear proof that investors are indeed really nervous. It's not just that they're hitting all-time highs either. It's also that these sorts of parabolic price movements are nearly unprecedented in liquid commodity markets, and that investors don't seem to be investing in other traditional safe haven assets. For context, in times of economic turmoil, investors often move to gold, but they also usually move to other things like government bonds. These are arguably slightly less safe than gold, as there's always a risk that a government defaults on its debts, but they offer a better return than gold and are generally considered to still be pretty safe. This tendency of investors to move towards government bonds during times of turmoil has acted as an incredibly effective safety valve on the global economy in recent decades. When crisis hits, investors essentially lend governments lots of money, allowing them to basically spend their way out of the crisis, or at least make it a lot easier to do so. Unfortunately for, well, everyone, that just doesn't seem to be happening at the moment. Instead, investors seem to be selling government bonds, as evidenced by the recent rise in global bond yields. That is the interest rate that governments have to offer on their debt. And there have been some pretty sharp upward movements in the past week or so. The yields on 30-year American, Japanese, and German bonds, for instance, have all risen by more than 10 basis points. Now, some of this is to do with specific things happening right now, rather than structural issues in the broader economy. In Japan, for instance, investors are nervous about Sanei Takeichi's expensive spending plans, which we actually discussed in the latest issue of our podcast, The World Leader Leaderboard. So if you want to find out more about that, then there's a link to that in the description. While in the US, investors are worried about the prospect of Europe selling off its holdings of US debt as retaliation against Trump's attempts on Greenland. More generally, markets are anxious about the prospect of a full-on transatlantic trade war between America and Europe, with various European politicians warning Trump that any attempt on Greenland would force a retaliation from Europe. Nonetheless, if you zoom out a bit, you can see that this is the continuation of a long-running trend, and bond yields have been rising pretty steadily across the developed world since really the pandemic, and at the same time, gold prices have been rising. Again, we don't want to get too alarmist here. There are lots of very normal reasons you'd expect to see a rise in government borrowing costs. For starters, lots of governments are running pretty big deficits, which means that they're issuing more debt and thus need to offer higher yields to attract new buyers. Moreover, inflation returned with a vengeance after the pandemic, which both resulted in higher interest rates from central banks, which pushes up interest rates for governments as well, and meant that investors now demand higher yields to compensate for the fact that inflation is eating away at the real value of their yield payments. Nonetheless, it is a bit unusual to see everyone piling into gold while simultaneously moving out of government bonds, which have long been considered safe haven assets in their own right. And this creates the possibility that, if some sort of acute crisis strikes, governments won't have the fiscal space to cope, especially because many of them are already dealing with pretty massive debt burdens. Now, it's worth stressing that no one, least of all us, knows when or if the next crisis will arise. And again, the global economy has actually held up remarkably well over the past year or so. Nonetheless, the surging price of gold probably isn't a good sign. And while the global economy has been able to cope with the recent succession of crises, it feels at least possible that the current confluence of crises, including yet another transatlantic trade war, a fiscal crisis in Japan, and escalating anxieties about a potential AI bubble, all backgrounded by Trump's renewed assault on the Federal Reserve, might overwhelm it. Now, you're probably looking to follow this story as it develops, but how are you supposed to keep track of which outlets online are actually trustworthy, and which are just fabricating a false narrative for you to follow? Well, that's where our sponsor this week, Ground News, comes in. That's because Ground News is a website and app that helps you to make sense of the complex and ever-changing media landscape. Now, things can get increasingly overwhelming, with thousands of articles being thrown at us every day, but Ground News puts all of those articles into one place, helping you to fully understand the story from start to finish. Each article even comes with a breakdown into bias distribution, factuality, and ownership of each source. For instance, if we take a look at this story on the recent slump in the US stock market, we can see that there are 122 sources currently reporting on it, with most of the coverage coming from the left. We can even dive into how each side is reporting on it using their bias comparison feature, showing that the left is blaming Trump's tariff threats over Greenland, while the right is framing the actions as a strategic lever against Europe. Our absolute favorite feature, though, is their blind spot feed. Here you can see all of the stories that you might not have seen on your feed. So even if you don't agree with the reporting, it's still good to know what's being left out of your bubble. Now, you're probably used to being fed the news that your algorithm has decided is best for you, and breaking out of that spiral is harder than ever. Ground News will do that work for you though, freeing you from the algorithmic restraints and letting you think freely again. So if you want to start questioning the narrative, instead of just consuming it, you can join Ground News today. And using our link, you'll get 40% off their unlimited access Vantage plan. All you have to do is subscribe using the link in the description. Go to ground.news/TLDR or scan the code on screen. And you'll be supporting an independent news platform working to make the media landscape more transparent.